This is an audio recording of the LendIt Fintech weekly news show. The show is streamed live on LendIt TV, LinkedIn, YouTube, and Twitter at 5 p.m. Eastern Time every Thursday. In this fast-paced show, the LendIt News team and a special guest discuss the most important fintech news stories of the past week. Good afternoon, everybody, and welcome to the LendIt Fintech Weekly News Show. My name is Peter Renton, Chairman and co-founder of Fintech Nexus, I should say, actually, the Fintech Nexus News Show. We went through a rebrand today. So with that, I'd like to welcome my colleague, Todd. How are you doing, Todd?
I feel refreshed with this rebrand, Peter.
Yes, indeed.
I'm doing good. How are you?
New and fresh around here. Kevin Travers, our esteemed journalist, back, I think, for the third time. How are you doing, Kevin?
Great to be back. Happy with the refreshed name.
Yes, indeed. So busy week in news we had here this week. So let's get right into it. Leading off, I thought we'd start off with FTX. They were in the news again this week. They're expanding. You know, we all know FTX from their ads with Tom Brady and Giselle, and we also know them as a crypto exchange, and now they're getting into stock trading. So they're really going up head to head with Robinhood. Funny that SBF, Sam Bankman-Fried, who is the CEO and founder of FTX, bought a 7.6% stake in Robinhood. We just talked about that last week, and now he's actually going to go into stock trading, going head to head. It's kind of a funny world we live in. It's just up for a few beta users right now, but apparently he's going to go out. Interesting piece. They're not going to be using payment for order flow, which I thought was really interesting. So, anyway,
well, I think that there's two interesting pieces that I think here. One is obviously the piece you said, payment for order flow. So they're willing to lose money, and the payment for order flow, it got a bad rap through Robinhood. It is absolutely standard across the industry.
Yep. I
know Robinhood got everyone in the news and in Congress in a huff about it, but it's not like it's new or they're doing anything that's different from other industry players. So it's very much the norm in the industry. Now, it might be controversial to some people outside the industry, but it's definitely normal for those inside the industry. And the fact that they're willing to lose money is odd. When they don't have to. The other thing is the opposite of traditional or typical fintech / bank going into crypto. It's crypto coming into regular market. So I think the inverse of what we usually see is kind of interesting. I don't know how long they're going to play with the "we're willing to lose money for no reason" game. But I mean, SBF is one of the sharpest out there. So there's got to be some play that maybe we're not seeing right now.
Yeah.
Absolutely. I was just going to say SBF has been on a tear in the news lately. He was calling DeFi or ICOs Ponzi schemes, even though he participated in something where you put money in a box and the number goes up. And then he said, like, Bitcoin last week wasn't a good payments product, and now he's jumping sort of the ship, it seems like, or heading towards traditional stock trading. I don't know. For me, if people are worried about crypto winter coming, that's sort of becoming more of a trend as prices go down. And if that does happen, if I were a big, crypto exchange, I would definitely dive, like, turn tail and run and go towards traditional securities or stock trading, because that seems to do better when there's not much Bitcoin to sell or whatever.
Yeah, and that's a good point. I think something you said recently, Todd. I remember you said that these like SBF and FTX want to be an exchange for all kinds of things, not just crypto. And they've talked about the futures trading, and FTX could end up being, having multiple different types of asset classes being traded.
They actually say in I think it was the journal piece, that what we eventually want to offer is an everything app for financial services. It's kind of like a new, I guess, somewhat of a new spin on a super app, though not really. It's just a different entry point to a super app.
Right. That's the thing. I mean, and we haven't seen the crypto people coming into traditional fintech very much, but it sounds like FTX is going to go there. Anyway, moving on. Want to talk about Plaid. Plaid announced this week that they are expanding into identity and income verification, fraud prevention. This is not a big surprise. They bought Cognito back in January. They're an ID verification company. And what they really envision, and we've all done it now. We all connected our bank accounts through Plaid, and all they rely on there is just getting verification from the bank account. But what they're saying is what they want to be able to do is verify identity during that process. So it's one seamless process. Remains to be seen. I mean, it's a pretty crowded space. There's some very successful companies doing great work. We've got Onfido, Secure, Centrelink, many others in this space that are specializing just in identity verification. So, it'll be interesting to see if Plaid can really pull it off as a one-stop shop, or whether people are going to want to go to specialists.
I mean, it's surprising it took this long for them to get involved here. I mean, it seems like a pretty natural place for them to be in with all their account connection. They made their bones on that. The fact that they've taken this long to get there is a little surprising. But there are, maybe part of it is the quality of the Secures and the Onfidos of the world, because there's a lot of good companies. And the other thing that struck me when seeing this is, at a time that things are getting a bit crazier in markets and whatnot, security is only going to become even more important to data, to the flow of capital from one place to another. I mean, every time you see a crypto hack of some sorts, you think back to, how is this possible? One, and then how do they bring in the guardrails that they need to ensure that money and identity, all this stuff, is as safe as possible.
Mm-hmm. Absolutely. I agree that it seems like it took longer than it should, but it's sort of after, because their main business is collecting data, connecting open banking. Yeah. So they already have a lot of our banking data that they use as part of their main business draw. It comes right after what Stripe came, and sort of the godfather of fintech comes along and sort of eats their lunch. And then they sort of offer this new, if we have people's data, we can KYC them. It seems to me like they're going for maybe a more business to business type product, where they're going to be now offering a service to safeguard apps by being like the defender. Because Todd is definitely right that security and cybersecurity is going to become even. I mean, we see it in the news. We get sent the press releases all the time. It's like a roaring industry right now, and Plaid's trying to jump onto it.
Yeah, it really is. So, anyway, let's move on to Klarna, because this was an interesting piece. Not exactly surprising. What was surprising to me was that Klarna's going back out to the markets to raise more capital. It just looks like they felt like they raised $1 billion or something close to that just last year, and now they're going back out, and they raised last year at a $46 billion valuation. Now,
just take that in for a second.
Yeah,
in 2019 they were at like 5 or 7 or something like that, and they jumped all the way up to almost 50 billion in less than 3 years.
Well, now they want to raise more money. And the thing it's in, like, a firm was worth, $35-40 billion 6 months ago. Now a firm is worth 7.2 direct comp to Klarna. And so we look at that, it doesn't look good for the investors. There's no way they could go out and raise at $50 billion or more. There's just no way. And they're talking in the low 30 billion. Now, keep in mind, Klarna has the most customers of any buy now, pay later company on the planet. They operate globally. They're huge. They are most likely going to be getting into, they already have expanded in other areas, and they are going to be a big diversified financial services play. But boy, it's a hard ask. We're going to see this again and again and again in the next 6 months, like these down rounds. If you don't go raise money, if you don't have to go raise money, don't. Because Klarna's going to show the way for a significantly down round, it seems.
Yeah, I mean, this could be the theme of not only 22, but probably go into 23 as well. that valuations are coming back down to earth. Companies that were able to jump a valuation almost 5, 6, 7x in the last couple of years are now dropping that valuation by a third or half, and if you're in the public markets, probably 75 to 80% at this stage. But it's something that's in some ways, I think it can be good in terms of resetting the market and kind of getting back to multiples that aren't obscene. But there's a lot of people and a lot of employees that are just going to get crushed by some of this with their RSUs, and it's a shame. But it's the good times weren't going to keep going on and on and on. Something like this was bound to happen eventually.
Yeah, and when it happens for Klarna, that there was rumors they were trying to go maybe public or maybe raise another round earlier 6 months ago. But the rumors why they didn't is that some of their underwriting or some of their money they've loaned out didn't come back to them, that they weren't as profitable as, I mean, you see so many tech companies that aren't necessarily like, they're not big revenue drivers, big revenue drivers, but not big profit centers. And now we're seeing, I think you guys are totally right that after absurd funding rounds, one after another, maybe you're not going to be able to 10x after 1 year when you're just adding a couple million more customers, and maybe things are coming back to earth.
Yep. Okay, so let's move on to Nubank. This is such an interesting story, and shameless plug, we have the CEO of Nubank speaking on our keynote stage next week. Fintech Nexus USA, it used to be called LendIt Fintech USA. It's happening next week. Anyway, Nubank reported earnings this week, and it's just like they added 5.7 million users in 1 quarter.
It's crazy.
That is just amazing to me. They now have 60 million users, most of which are in Brazil. There's a couple million in Mexico. They're increasing their revenue per client. They're still losing money, of course. And one thing that I thought was fascinating in their earnings report, they said they are now the #1 new credit card issuer in Mexico. So that's quite impressive. And I just think they continues. I mean, how do you like they've got now, I think it was like 57 million users in Brazil, which has, I think, 200 and low 200s million people. So if you look at adults, probably like 160 million adults, and they've got 60 million customers. It's just so impressive to me.
35% of adults, basically.
Yeah.
I mean, this is probably going to be the first real pan-regional digital bank or fintech that truly gets on the scale of a traditional bank. I think we've seen a lot of fintechs have rapid success. I mean, even our previous story, they have 46 million customers. Nubank not only has that, but these are sticky customers, which is the opposite of buy now, pay later in many ways, which is something I think that area of the market needs to grapple with. But they've probably a year and a half, I think they've been in Mexico, and they're already #1 in credit card. I mean, it speaks to credit cards in Mexico for one, but for them to jump up that quickly is crazy as well. This is the perfect example of a digital bank that just right up there in terms of real competitive juices with the traditional financial system.
We're excited to see. This is a company I definitely love watching because they are sort of like an inspiration to what companies can be in hyper growth in LATAM, especially. It's so cool to see their growth. They're 1 year in Mexico, and now they're the top issuer already. It's so cool to see products brought to people that didn't have them before. And though public markets beat them up as they beat up all fintech stocks recently, I know they must be keeping their head down and just growing more because they have the stickiness of the users, the top of wallet, like it's the main bank these users have, and it's not going anywhere.
Right. Yeah, no, that is very true, and I feel like Nubank is, they are going to be a force to be reckoned with. They already are, But in the long term, I think they're going to be. You'll see a big Nubank building in downtown Sao Paulo one day. It'd be my guess that they are just they continue to crush it. Anyway, we got to talk about Robinhood. It seems like we talk about Robinhood every single week, and this week they launched or they announced. They didn't launch. They announced they're going to have their own self-custodied wallet. So, like to compete directly with MetaMask, Coinbase now has one as well. It's also going to be a way for them to sort of sneakily kind of get international customers, because right now they're really mainly US focused. And they have, I just went and checked. I actually signed up a second time, and they have 500,000 people now on the wait list. I think I'm actually at like 110,000 or something is my first sign up. But this it's a diversification play. The one thing that was most interesting, they're not going to charge gas fees. They said like they use Ethereum, and they're not going to charge network fees. So they're going to make up for that elsewhere. But
payment for order flow.
Yeah, I was just thinking.
Payment for order flow in crypto, maybe.
Well, there you go. The opposite. It's the tie this together with our first story is just the fascinating pieces of the interplay, especially with SBF buying the stake in Robinhood and them going deeper into the Web3 ecosystem. Those two things are just fascinating interplay with one another. Robinhood needs to get away from just the fun and gamification of stocks. Mm-hmm. And this is one way to do that, especially with those that they cater to, which is the younger generation. And clearly younger people like Kevin are into NFTs and are certainly accepting of this new world a lot faster than even my generation or older
my
generations.
You can say it.
Yeah. But I mean, they're a lot quicker to say, hey, I'm giving NFTs a whirl, or, the people as you go up the scale in age, there's a lot more, all right, I'm conservative. I've gotten to this point. Like, I know that Kevin's generation doesn't like to take on credit, but they're also willing to try stuff like this.
Mm-hmm. Yeah. It's funny to see how maybe they're going to team up one day, Robinhood and FTX, but they're going in opposite directions, and Robinhood is going towards, I guess, something more like Coinbase. They ran out of their steam as like a fun stock better, and now they're going towards one, international, and two, this NFT Web3 place. But if you look at Coinbase, their main alternative as like a public US crypto company, they launched an NFT platform that hasn't done so well because people tend to go towards decentralized like OpenSea or some non-public, non-big giant firm that's going to hang out and collect your NFT collection or whatever. It seems like people don't like going towards these larger organizations for this type of product. So it'll be interesting to see if it works for Robinhood, because it hasn't really been working for Coinbase. And it's with a recent disclosure from Coinbase that we've been told other crypto companies have to use too, is that if you can't afford to pay back or safeguard or the SEC says if you can't afford to pay back or safeguard your users' funds on your exchange, it might be able to be taken in a bankruptcy. So not your keys, not your coins may ring true, and Robinhood might run into trouble with that right when they're trying to open up towards crypto, I guess.
Yeah, no, that's another topic for I know that we discussed last week with Coinbase, but yeah, I mean, like the question is, how many of these wallets are going to be, are we going to have? I think, Robinhood's got a good shot at it. I mean, obviously MetaMask has I think they got like 20 plus million users now, but that doesn't mean the company that comes first. I mean, I feel like these wallets are going to be around forever, and we are going to interact on the web through wallets like these. And there's only going to be 2 or 3 winners, I think, in that as far as non-custodial wallets go. And it could be Robinhood, who knows? But anyway, I want to move on. This was interesting one that I didn't actually realize this was happening that much, but apparently it is, where people like crypto companies talk about FDIC insurance. Like, every bank account is insured up to $250,000 of FDIC insurance, and they want apparently there are some crypto platforms sort of implying or even outright claiming that they have FDIC insurance and they don't. And so the FDIC, and not surprisingly, and the CFPB as well, are clamping down on this, and also making any non-banks, and that includes all of just regular fintech companies, make sure they disclose clearly that they have, like Chime is not a bank. Chime has a bank. I can't remember, is it the Bancorp Bank? I can't remember who they use, but they have a bank where they just store all of Chime's customers' money. Same with Dave, same with Moneyline, same with all of them, and they just want to make sure that's clear.
This is like the ultimate jackass move. And if I was a crypto executive, I'd want to find out who these companies are and call them out, because the only thing that this is doing is annoying regulators and legislators that the crypto industry, fintech, whatever, can't be trusted if this is the type of practices. And let's be frank, no real legitimate company, the Coinbase type company that's kind of looking to scale and do things the right way, is going to play this game.
No,
these are on the outer edges, but it gets play because the CFPB and FDIC are looking into companies that are on the outer edges, and then it just gets heightened and then gets thrown in the news, and it puts people, quote unquote, on notice that they're paying attention to it. But if you're doing this is just the dumbest move. I mean, you're just asking for regulators to clamp down on you even more.
Yep.
It doesn't make sense. I know Jason McCullough actually pointed out a Y Combinator backed company called Stable Gains that they didn't outright say they said, like, you have 15% staking, we'll pay you back, whatever. But they didn't say outright FDIC, but they do have an FDIC like logo, and they say they're US registered, they say FinCEN registered, just with the type of language that relates to.
Right. And I think that's what they're mainly getting at. I mean, if you go out and say you've got FDIC insurance and you don't, that's black and white. You either do or you don't. But I think that's what they're going after, Kevin, are those kinds of people.
It's nuts, because why confuse it? We know it's hard enough to get FDIC, but now they're saying you got to earn it, because it's nuts.
Yeah. Anyway, moving on, I want to talk about two of my favorite people in fintech, Rob Frowine, Catherine Petralia. They were the founders of Cabbage that was acquired by American Express. Rob left, many months ago now, last year. Catherine is in the process. This is her last month, I believe. She's in the process of leaving as well. They have a new company, Keep Financial. They've just raised $9 million, led by our friends at Andreessen Horowitz. And I sat down with Rob, actually, was at the Dealmaker Summit in Miami, where I sat down with him and he explained his new company to me. And what it basically is, it's almost like it's a retention tool, an employee retention tool, where you want to retain a high-paying employee, you offer them a $100,000 bonus, but it's really a loan. And if they have to pay it back, if they don't stay for, say, 3 years or whatever, and it amortizes over a certain period, they manage all that for you. They're basically, what Rob is saying is that there's like $8.9 trillion in compensation in this country, and there's only 2% of that is used for bonuses. And he's saying that people want to retain more than ever now, because of Great Resignation. People want to retain their employees, and so it's a good timing for that. Where that's concerned, people are open, I think, to new ideas to help retain employees, and that's what they're going to be doing.
Yeah, I think that's the wider trend to look at here. I honestly don't know a ton about their new venture just yet. I mean, I would put a lot of stock in what Rob and Catherine do because of their past success, but I think we're probably going to see a lot more innovation in the space of different ways to incentivize employees to stay. And, we've already seen it seems as if 2 to 3 days is the sweet spot to allow people to come in the office. And how does that play? And then you add stuff like this into it, and other incentives, paying off student debt. And, it's a space that needs more innovation. Because I think traditional compensation is going to get maybe not fully turned on its head, but people don't necessarily want, all right, here's every 2 weeks I get paid and I go into the office, I go home. They want to think of a life for themselves and then try to take a job and fit it to the life that they want versus getting a job and then figuring out their life from there. And so I think innovation and thinking through ways to throw that around could really help employers keep their top talent.
That's what they call themselves. Keep Financial.
Keep Financial. I think
Play on the words.
Great idea. As a fairly young, like recently in the professional working space and had it all delayed and interrupted by COVID, and now Great Resignation is here. My generation definitely is looking for something different or more, innovation or change, from compensation, from what we expect our work-life balance to be. Everything's up in the air because nothing was there in the first place by the time we even got into work. I watched the movie Margin Call. It's all about bonuses and stock options whenever at the end of the movie when they're all getting fired because the housing market crashes. But Kevin Spacey's character is forced to stay on for 2 years so then he can later collect his stock options and bonuses and everything. And he says, after 30 years, I still need the money. It's funny because under Keep Financial, you would stay there on purpose because you already have your bonus and your vested stock option. You don't need to leave to sell it. That's sort of it's a very cool idea.
Yeah. Okay, moving along, I want to give Xendit a shout out. That's the largest funding round of the week, $300 million. They are a Indonesian-based fintech. I actually had them on my podcast just this week. It'll be out early
Shameless
June.
plug.
Yeah, but I went in to this thinking, they're a unicorn in Indonesia. They'll be somewhat interesting. My God, I was so impressed. They call themselves, or others call them as well, the Stripe of Southeast Asia, but they're more than that. They do provide payments infrastructure. Like where Stripe came and made payments infrastructure better, they're creating payments infrastructure from scratch. And because there isn't some, it's just crazy how people operate in Indonesia. They have massive smartphone penetration and really low bank account penetration, and people just people pay in cash still. And they needed to create this, and they've done a really great job. And they just raised $300 million. Cotu and Insight Partners, big names. I think they're going places.
Sounds like LATAM.
It does. A lot in common.
Cell
Southeast
phone
Asia.
penetration, low bank account,
Yeah.
cash transactions. It's a very similar type of story, and what those markets need more than anything else is good infrastructure.
Yep, exactly, and that's what they're creating.
Absolutely, infrastructure. It's like LATAM, but it's even less. Like they're not competing with anyone else for credit card offerings like they could be in Mexico. There just is no. It's just cash based only. So they need infrastructure. They need something new, and it's going to be an explosion. We need to send people down there.
Yep, we need to have a Fintech Nexus Southeast Asia. It's coming one of these days. You never know. Anyway, I want to end with our good friend Ron Shevlin. He had a new survey out. They do this every year. Basically, they survey. I think it's 3,000 people. Don't quote me on that, but they survey a few thousand people and find out, because none of these companies basically tell you how many customers they have. So they take a sample size of the US population and then extrapolate out how many customers they have. So Chime is the leader, not surprisingly, 14.6 million. Current second at 5 million, Varo third at 4.3. And the thing that was most interesting to me is that Current added more customers in the last year than Chime, according to Cornerstone Advisors. So it's heating up in the digital banking race.
Let that sink in for a second, and then think back to our second or third story on Nubank.
Yeah. And
the amount of customers that Nubank has acquired over the years. I mean, it's 3, 4, 5 times some of these companies. And so it's fascinating to see that story. And these are pretty good success stories here, but the U.S. market is hard to get real large penetration. I think Chime's done a great job. I think we're about to, I don't know if this year, sometime next couple of years, there's going to be some pretty big consolidation.
Yep, for sure.
It'll be awesome to watch. I loved how how still more younger generation people, Gen Z, Gen X, are using like their first and only bank is an online digital bank, and it's no longer like they're challenging. It's not like a challenger bank at all. It's just that's like a third of the population's banking choice is some sort of partner bank or some sort of mobile app.
Yep. Even my generation, the Gen Xers, are choosing more and more a digital bank as their primary bank, and I think that's it's a good thing, and it's only going to increase. And it's a one way. It's going to go one way for many, many years, I think. Anyway, we're out of time. Before we go, though, final plug for LendIt Fintech. Fintech Nexus USA. It's going to take me a while to understand that. The biggest event in New York all year for fintech is happening next week. There are still tickets available. Go to lendit.com, find out more, and it's Wednesday and Thursday next week. 3 of us will be there, along with several thousand other people. You should be there too. Anyway, we are going to be off next week because we will be at Fintech Nexus USA. So we'll see you all in 2 weeks. Thanks, everybody.
See ya.
See ya.